So today we are going to discuss another interesting topic, which is on intrinsic value. Intrinsic value, if you see, it is very important as far as value investing is concerned. So if you see the earlier sessions of our value investing series, you must have come across intrinsic value. What is intrinsic value? What is a value investing? All those things. So today we are going to discuss in detail how to find the intrinsic value of a company. So the company here in focus is NAVA Limited. So we have covered about NAVA Limited, its fundamental analysis, everything in our earlier session. Today, I am helping you to find out the intrinsic value of the company. So hope you have seen my earlier session wherein I have done a fundamental analysis on the stock NAVA Limited. So once you do the financial health checkup, then if you are convinced on that company, then it is very important for us value investors to look into the valuation of the company, whether it is undervalued, whether it is fairly valued. Should you enter the stock at this point, or should you wait for the company to correct, or for the valuations to be fair enough for you to enter? Also, I am very happy to know that the earlier session number 88, wherein I had done a fundamental analysis and a deep dive into one of the company, which is Rajesh Exports. We have done forensic audit on that company. Then many things we had discussed how to analyze a company from that perspective, and I have got nice comments on the same, and also uh, people have liked that. So I'm happy that analytical videos are always liked by our subscribers, and new people are also coming into our channel. So I will try to include more of analytical videos going forward if this helps you as an investor. So without wasting much time, let us get directly into the topic: how to practically compute the intrinsic value of a stock. Before getting into the session, already I have mentioned that valuation check only comes after thorough financial health checkup of that stock. So we have already done the financial health checkup of NAVA Limited. So after seeing that only you see this video. Also, please note that this is not a stock recommendation. I have got holdings in NAVA Limited. That's a disclosure I'm doing here. But this is never a stock recommendation. You have to do your own due diligence. You have to contact your broker or your investment manager before investing into any of the companies, including this. So you must have understood what is a intrinsic value, all those things in my early sessions. So if you have not seen that, please go and visit that sessions, and then you come into this video. So if you see quickly telling intrinsic value, on the screen you can see a sketch wherein the market price or the current market price of the company is 100 rupees. And if you see the intrinsic value computed for that particular stock is just 90 rupees, and 100 minus 90 is what is the overpriced level, you can say. So the intrinsic value of the company or the stock is basically based on the fundamentals of business and the earnings potential or the free cash flow generation capabilities of the business. And if you see the overpricing or the overvaluation of the company at 100 rupees, which is like 10 rupees higher from the intrinsic value, is based on market sentiments and the price momentum which the stock have. So this is just an example. So the if it is 100 rupees, the overvaluation can be 50% also. Like 50 rupees can be the intrinsic value, and 50 rupees can be the overpriced level as well, which is like the stock is highly cooked or overpriced, and we as value investors should never enter such a stock. So what we are going to find out is that you have a market price, and we will be finding out the intrinsic value using some methods which I will be mentioning here, and then we will understand what is the margin of safety, or what is the uh, discount to which the stock is trading compared to the market price, or is it overcooked and overpriced, and we will not be able to enter at this stage. Also, please understand that intrinsic value is an estimate of the valuation of the company. Every analyst can do their own valuation methods, and the same valuation methods, even if opted, can have different results, because the assumptions of the future growth of the company, the discount rates, the cost of capital, everything which has been considered can be different from person to person based on his understanding about the market, and also the growth prospects of the company. Various analysts are anticipating based on various factors can also vary. So this will actually have a good impact on the intrinsic value which is being derived using these models, which we'll be discussing in detail going forward. So you can see in the Excel sheet, which I normally use for deriving the valuation of various companies. Here you can see I have mentioned it as NAVA Limited. So the detailed fundamental analysis of NAVA Limited already I have done in session number 55 of our value investing series. If you have not seen, please go and see that. Now the method one is multiple valuation method. Like some multiple is utilized for valuing the intrinsic value of the company. So the multiple which I have used here is price to earnings ratio. So a 5 years price to earning ratio has been considered. You can get it from Value Research, you can get it from Money Control or any other sites. So you can get PE of each of the years, last 5 years, and you can take an average also, and you can find out the PE ratio average. So I have currently taken it from Value Research, and also if you see, I can use various ratios here. Like instead of price to earnings, I can use EV to EBITDA, I can use price to sales ratio, all these ratios. So whatever ratios you use, end of the day, the price is projected from that ratio uh, to to derive the intrinsic value. So directly, if you see here, I have taken the P ratio of Nava Limited for the past 5 years as 4.5, and I have taken a margin of safety because if you see, this is basically to mitigate the risk of the faults in our estimates. So if you see what is margin of safety, I have already mentioned that in our value investing series session number 3. So if you have not watched that, please go and watch that. So we apply a margin of safety of 25 to 30%. Here I have applied 30%. Now a conservative growth rate is also applied. Like in next 5 years, how much the company will grow per year. So basically expected growth rate I have taken as 12%. So this 12% is again based on various analysts, various company earnings calls. So what is the growth rate? All those things you have to understand by fundamental analysis, listening to the management earnings calls of various management. The Nava Limited earnings call is available in YouTube as well if you search. So also the analysts are projecting their own opinion about the company. So and also you should have your own analysis. Based on that, you will derive an expected growth rate. For me, it is derived as around 12% per year. So after applying a 30% margin of safety, so 12 into zero point 0.7 will give you 8.4%. A conservative growth rate is what we call, because after applying the margin of safety over the expected growth rate. And also I utilize something called a discount rate. So discount rate is nothing but what we call as weighted average cost of capital. Again, what is weighted average cost of capital? I have mentioned in my session number 13 of our value investing series. So if you don't know about weighted average cost of capital, go there and understand that. So I know this is slightly complicated, but the valuation model itself is a high funda game. But I am trying to clearly share you my knowledge on this, because this is something which you won't get it in an open channel like a free YouTube channel like mine. But still, I'm trying to share these things so that you will have a clear understanding of valuing a company. So discount rate, that is nothing but the actual cost of capital. So always I say that investing is a game of having a higher return on investment compared to the cost of capital. Like you have taken a loan at an interest rate of say 10%, and if you are getting a return by investing that thing in some stocks at a rate of return of 18% yearly, 10% interest rate on the loan you have taken, which is the cost of capital, and the return you are getting from the market, that is the stocks, is at 18%, means it is having a 8% delta. So that investment is justified because you are paying the 10% interest rate from the returns of the stock. In addition to that, you are getting a 8% extra return. So that is how you evaluate the actual cost of capital. So weighted average cost of capital also you derived. Then after that, applying the equation, you got the intrinsic value. So here the intrinsic value per share is 231.28. So it is to be known that this method one of multiple valuation, I don't normally look into that much, because it has something to do with the price of the company, though it has got sales or earnings in the denominator, but numerator is governed by price, and price is something which is governed by the emotions and the uh, thinking of the market participants or the investors. So already I have discussed all this reflexivity analysis between the uh, market participants understanding of the market and how the stock actually performs. So this reflexive relationship is all mentioned in the Alchemy of Finance by George Soros. This we have already done in detail with a practical example also in our earlier sessions. Please go and watch that as well. So as per that valuation metrics of price to earnings, the margin of safety is -40 because the NAVA Limited is currently trading at 387 rupees and the intrinsic value derived is 232 as per the price to earnings model, which is the multiple valuation method. So let us park it. So as per this, the stock is not a safe bet. Now getting into my favorite, which is the discounted cash flow model. Now talking about discounted cash flow model, the major steps involved in the discounted cash flow model is like first forecast the free cash flow. So what is free cash flow we have discussed in our earlier session. Please go and visit that. So we will discuss in detail in the Excel sheet how to forecast the free cash flow. Basically the forecasting means the future free cash flow we will list out say for next 5 years or 10 years based on the previous data or the previous operating cash flow and the capex which is been uh, done by the company for the past years. Now second is deriving the expected future growth rate like what we mentioned in the earlier price to earnings multiple method, wherein the expected future growth rate of the company, whether it is analyst based or whether it is company's expectation or whether it is your own derivation of the growth rate of the company based on various fundamental analysis you have done or the various news on which the company is based. So based on this, you will derive the expected future growth rate. Next, computing the weighted average cost of capital, the discount rate. So the actual cost of capital. This is also discussed by us in while discussing the price to earnings model. The equation for weighted average cost of capital, we'll find out the discount rate. Now we calculate the terminal value. So terminal value is nothing but the value to be applied over the free cash flow projection beyond the years of analysis. Like if you are analyzing the company for or projecting the company's cash flow for next 10 years, then beyond 10 years, what will be the growth rate of the company is nothing but the terminal value. So also we will discuss in detail how to compute that. And the next step is to discount the free cash flow and the terminal value. Then finally computing the intrinsic value of the stock. Again, getting back to our Excel. Here if you see in the discounted cash flow model, I have put the stock price. So the stock price of NAVA Limited is currently 387 as I speak. The total cash, which is nothing but, see, I have added, if you see this, this is like the uh, cash in hand and in bank. Then there is investments also by the company in various mutual funds and other funds. So the like mutual funds are like considered as cash and cash equivalents because anytime you can sell the mutual funds and or securities or bonds and convert it into cash. So though it is not clearly the cash, it can be converted to a cash without any liquidity crunch. So it is also considered as a cash or cash equivalent, we can say. So total is around 846 or 847 crore. Total debt also is like uh, 3000 or 3066 crore. So that you have to mention. Operational cash flow you will get from the cash flow statement. So all these things we have already discussed in detail uh, in our session 26 to 28, 26, 27 and 28 of our value investing series, wherein I have mentioned about how to analyze a P&L statement, a balance sheet, or in that case a cash flow statement as well. So you will get those details like operational cash flow from that. It's around 1200 crore. The investing cash flow, basically this is the capex. So capex is basically what the company spends for establishing the business. So basically there are two capex. One is maintenance capex and one is growth capex. Basically we should be utilizing the maintenance capex, but actually one of the cash flow statement gives the maintenance capex and the growth related capex separately. So it's a single value. So we will consider the complete value conservatively. So regarding the cash and cash equivalents, if you see here, cash and cash equivalents is there, bank balance is there, then investments is there. So 1, then 3 and 4. These 3 added is what I mentioned as the 840 crore. See, this is what the zoomed view. So investments, cash equivalents, and the bank balance. This three we have to add for cash and cash equivalents. Now coming to the here, if you can see in the cash flow statement, you can see the operating cash flow is 31st March 2023 is 1,223 odd crore, and the uh, capex is, if you see, purchase of property, plant and equipment. So that's around 100.46 crore. So as the units are all in lakhs, we have to divide it by 100. So that's why I'm converting into crore and telling. So once you got this value, again you put that here. So free cash flow is nothing but, as we mentioned in our session number 14, operational cash flow minus the capex will give you the free cash flow. So free cash flow for that year you got as around 1,100 crore. So basically for 2023, then shares outstanding you will get from the annual report or from any websites like Value Research or Money Control or Trendline, whatever it may be, and that's like 14.51 crore. The expected growth rate, as I mentioned, based on our estimates or analyst estimates, I have mentioned 12% margin of safety to mitigate the risk in estimates of ours, 30%. So conservative growth rate, again we explained earlier, so 8.4%. Now the decline rate, growth decline rate means, this is like the theory of law of large numbers. Means as the company grows, say it's a small cap or mid cap company, the company grows. So if it is small cap, the growth rate will be very high. There is huge gap for or huge space for a company to grow. But as it grows in a faster rate, then once it becomes big, then it is difficult for the company to grow in a faster rate like it was doing in the earlier years of its starting period or your uh, earlier periods, you can say. So at that time, then the rate or the growth rate also dampens or it reduces. So I have taken a growth decline rate up to 5 years at a rate of 5%. Like the decline is not much year on year, but after 5 years, because I am projecting the free cash flow for the next 10 years and then discounting it back to the current time to get the intrinsic value of the company. So here the growth decline rate I have considered at around 9%. So after 5 years, after first 5 years, then for the next 6 to 10th year, I am considering a growth decline rate of 9%. So I think whatever analysts, majority of the analysts take a single growth decline rate of say 5% for the 10 years. But this is my style of doing, wherein I make it more realistic by splitting it into two lines, one 5% and one another a higher decline rate as the company grows big of 9%. Now the discount rate already we have computed, which is nothing but the weighted average cost of capital. The equation and all those sessions already we have mentioned in session 13. So that is simply incorporated in this. Now valuation last FCF. So this is again used for computing the intrinsic value. So here what I'm doing, I'm applying the conservative growth rate and the cost of capital, nothing but the weighted average cost of capital. I'm using this and I'm uh, finding out that value of valuation last FCF. Then debt to equity ratio is required, beta is required, you will get it from money control easily. Then the returns of bonds, basically AAA bonds, which you will get from the Google or website or something, wherein it is at 7%. You can consider 7 to 7.5% as well. Then the bank loan interest rate is around 10.5%. So you can take a personal loan interest rate say at 10.5, because we are considering all these things to find out the weighted average cost of capital, which is nothing but the actual value of the money, or we are taking it from a loan, we are taking it from a bank or something like that. So we have to consider what is the interest rate offered by the uh, bank, or what is the, while if you are investing that money in some bonds, so the bonds will return some money, or the bonds will return some coupon rate, or what you call as the interest rate. So if you are investing the money in say this NAVA Limited, then you should compare the available uh, other alternatives like your FD returns, how much it will give you, your bonds, if it is invested that money, then how much it will give you. Then if you're taking a loan, then how much you have to pay to the lenders or bank. So this is all compared with what you are expecting from the stock market return, which is 12%. So comparison of the stock return versus what is your cost of capital is, which is all built into this equation of or single figure, which is derived for weighted average cost of capital. Now this is all computed. Now you have a cash flow projection, free cash flow projection. So what we are doing here, we are multiplying the growth rate with the free cash flow for every year till 5 years. We are taking a I'll show you for further understanding. We are taking a growth decline rate of 5%. Then further from 6th year, I am taking a growth decline rate of 9%. So conservative growth rate remains same almost at 8.4 for all years. So this that you can see here. And in addition to that, so you are taking the first free cash flow which is derived for this year. Then you are applying the growth rate and decline rate for the next 10 years in the rates which we have mentioned to project the future cash flows. And also the net present value, as I told, we will apply the discount rate, which is nothing but the cost of capital for every year and discount it back to the current year. So that is nothing but the net present value. So if you see, this is the cash flow projection, then we are discounting it to current date with a discount rate which is nothing but the weighted average cost of capital. So we have come up for all the 10 years, we have come up with that net present value. Then we are summing the complete net present value. Now that is again called here. Then the 10th year we have to multiply it with the valuation last FCF, that we mention it as terminal value. So terminal value is multiplied here and you will get the 10th year free cash flow value. Then cash in hand already we have derived there from the P&L statement as 846 crore. Total debt already it is there. Now the company value we get by adding the net present value of free cash flow. Then the on the 10th year, what is the total company value, which is derived from the terminal value, which is nothing but 8461 crore. Then cash in hand you add, debt you minus, because whatever is there, if you are selling the company at a particular date after 10 years, then you have to subtract the debt because the lenders will be paid off as soon as you liquidate a company. So that is subtracted from that. Then you get the total value of the company. Now you divide this by the shares outstanding. This is already mentioned here as 14.5 crore. So total company value divided by the number of shares has given me or around 1200 or 1150 rupee per share. So currently the company is trading at 387 crore. Dividing it by this value is giving me a margin of safety of around 200%, which clearly shows that the company is having a huge undervaluation. Already the multiples of PE or price to book, everything also depicts that it's an undervalued company. Now if you see regarding the debt, so this debt is also going to be cleared once the Mamba Colliery, the Zambian government clears the debt. So the standalone debts are very low. It is basically from the external operation or basically from the Zambian government debt. So if they clear it off, say they reduce that 3000 crore to say 100 crore debt also, then the investments also would reduce because going forward they streamline the business. Then they have already done enough capex in various sectors. So also the Ivory Coast and all those things, the capex is expected. So let us keep the capex slightly higher. Say if I consider 200 crores also, or say 250 crores also with a lower debt, then even if I consider expected growth of say 10% also, then also see if you see the intrinsic value I am getting as 1000 rupees around or 1100 rupees, which is again having a margin of safety of 182%. So clearly if you see, you can see the company's rightly valued or it's having a good undervaluation. And also you have to keep changing these figures. So cash in hand, maybe once they sell off the plot in that 60-acre land parcel they are having in uh, Andhra Pradesh. So once that is liquidated, also there will be huge sum of money coming in. So this cash can go up. So you can change the cash into say 1,000 crore or things like that. And debt also is reducing that I mentioned. Then the capex also slightly increases. Then also the operating cash flow can also increase as the profitability increases. So that uh, permutation combination you can do. And also the expected growth rate, if the company is debt free, then they can grow at a higher rate. Say it can become 15% also, say it can become 18% also. Then all these things you can put. Then margin of safety, if you want 25 instead of 30, then also if you do it, then the intrinsic value goes up. So that permutation combination you can do and you can derive the intrinsic value. So as you have seen in the multiple valuation model, the method one for intrinsic valuation, we are projecting various multiples to next 5 or 10 years and understand the or derive the intrinsic value, the actual value of the company. Then the second model is wherein we are calculating the free cash flow, then forecasting that for next period, say 10 years, then discounting that to the current time, and then adding all the cash and subtract the debt from the company, then understand the company value. And this cash flow projection is also inclusive of applying various discount rates and growth decline, etc., and conservative growth rate with a margin of safety, as I mentioned, and project the or understand the intrinsic value by finding out the net present value of that cash flow projection. And this gives you the intrinsic value of the company. So I always follow or I always do a DCF model for all my stocks under my watch list or the stocks which I am planning to enter or invest into, because it is very important that free cash flow is something which which an investor should always look at. Because if a company is having a bit of very high or year on year the EBIT is also increasing, it's of no use. Because what is more important is what you are getting as cash in hand, which is nothing but the operating cash flow minus the capex. So that is something which is realistic and which is measurable compared to other figures, wherein it is all accounting projections, but actually in hand you don't get nothing. Uh, some companies are like that as well, but I'm interested in companies wherein you get a uh, great free cash flow every year. Now the third method is ROE valuation. So again, the third important method is ROE valuation. So here also the current market price already it is available. Shareholders equity you get from the financial statement balance sheet. Then ROE also you get you take it for an average whatever years you are projecting it for. Say I am projecting here for 5 years. So 5 years ROE average you will get from value research or any other uh, money control or something. So I've taken it from value research here. So ROE for a 5 years period is mentioned here. So it's 14% for NAVA Limited. Now the dividend yield also is mentioned here, and also dividend per share is 6 rupees. Earnings per share is 64 rupees around. Dividend payout ratio is computed based on the dividend per share divided by the earnings per share. So that is nothing but the dividend payout ratio. Like whatever earnings you are getting or the profit, total profit of the company divided by the shares outstanding is nothing but the earnings per share. And out of that, how much money is given as dividend to the shareholders is nothing but the dividend payout ratio. Margin of safety already we discussed. Conservative growth rate ratio also we discussed in the above valuation method for DCF. Discount rate also we the same as that what is derived in the above sheet. Then after that you project the ROE for 5 years, which is already listed here. So this is for the past 5 years. So starting from 2023, 2022, 2021, 20, 2019. So those four values I have taken for just getting the average value of ROE. So if you directly get the ROE direct value average, then you need not tabulate this only. So also this earnings per share and price to book is nothing to do with for this calculation. I have just taken it for just my understanding. Now shareholders equity already you have for year 1. So that what you are doing, again, just like free cash flow model, you are taking the conservative growth rate. So taking the conservative growth rate, you are projecting it for the next uh, like 10 years. So next 10 years with a if you see here, one second. Yeah, conservative growth rate you are taking. So here it is 8.92% and you are projecting it for the next 10 years. Then dividend also, if you see, you are projecting it for the next 10 years. Dividend yield is 2.75%. Then the conservative growth rate again is 8.92. You also project it for the next 10 years. After that, you apply the discount rate. After that, now, like just what we have done for the free cash flow, we apply the discount rate and project it for the next 10 years. Then you get the sum. Then again you take the sum, then the required value is there. Now based on the ROE model, you got an intrinsic value of 640 rupees. So 640 rupees is the valuation or the intrinsic value as per ROE model. So again, this is having a margin of safety of the current market price is around how much it is, 387 rupees, and currently it is 387 rupees, and the intrinsic value as per ROE model evaluation we got 640 rupees. So again, a margin of safety of 65%. So if you see from model 2 and model 3, or the method 2 or method 3, it is clearly an undervalued stock. And if your fundamentals are clear, so this is not a stock recommendation, but already I have done my due diligence on the stock and I have done a video wherein I have explained the fundamentals of the company. That is in session 55. So if you consider that, and if you consider this valuation methodology, then it is very clear that the company is having an attractive valuation. And also if you see, you should always explore why this undervaluation is there. That is the skill of a true investor. So a company cannot go on a cheaper valuation just like that. There will be something which some people are missing, or there is some bad things happened, or maybe because of some nature of the business the undervaluation has happened. So it is, as an investor, your skill to understand why that has happened, and then apply your skills and find out the actual valuation of the company. Then if it is undervalued, if your financial health checkup is done, if your future projection of cash flow or profits are in place, then if you have a clear conviction about the stock, then you need not look into anything else but just invest in the company. Again, I disclose that I hold this company. I have, and I am not asking you to invest in this company. Do your own research. This is a model which I have given you just to understand the valuation methods, and you can apply this for any of the companies you are analyzing or you have in your watch list. I also recommend you to do this valuation check for all the companies you are holding in your portfolio, so that you understand that where your valuation of the company is, whether it is overcooked or undercooked or fairly valued, so that you can uh, rotate your stocks or book profits in some stock and reinvest that money into other stocks, understanding that the uh, uh, stock is too much overvalued. So I'm sure that this is slightly complicated video. You should take time to understand this. If you have any doubts, clarity, you can ask me. This Excel I am not sharing to you currently, but the methods or the equations which is already available in various sessions in our value investing series. So you apply that, do your own Excel calculation. Then if you are stuck up somewhere, then come to me, then I will help you. Once you are done that, you give proper comments or your doubts in the session, then I will clarify that. Then I am happy to share this sheet to you, so that you value the sheet or the concept. Otherwise, if you get this sheet ready made, you will not put in your efforts and you will not understand the actual valuation technique. Hope this session was useful for you. See you soon on yet another video wherein I'll be coming up with some another interesting topic, or maybe some more analytical video on some of the stocks which I am currently analyzing, because I've seen that people are appreciating the analytical videos rather than some conceptual videos. So I will include a mix of both of these, because concept understanding is also important for analyzing a company in detail. But in future, I'm sure that I'll come up with more analytical videos. See you in next video. Till then, happy investing.